Hi, a very good evening to all of you. Today we've gathered to talk about the Axis Arbitrage Fund. When there are already a host of options available in the mutual fund space, a lot of you must be wondering as to how exactly is an arbitrage fund going to help me in my investments? How risky is it as it invests in the equity markets? And what is the tax advantage that an investor can get? To answer all of this and much more, we have with us Mr. Karthik Kumar from the equity investment team. Karthik joined us Axis Mutual Fund in 2019. He has a widespread experience in building and managing quantitative strategies in India and for the Asia Pacific region. At Axis AMC, he has managed portfolios across the AIF platform and, of course, is currently responsible for managing the Axis Quant and Arbitrage Fund along with the passive equity strategies. So, over to you, Karthik.
Thanks for the introduction, Tanvi. Thanks for that. So what I'll do is I'll give a brief overview of where the markets are, and go run through basically what is arbitrage fund and why one should look at arbitrage funds as of today, right? So with regards to where markets are, we've had a fantastic December so far, barring today, where we saw a minor correction. But the fact is, the U.S. Fed because softening their stance on interest rates, given moderating inflation rates in the U.S., the election outcomes, state election outcomes in India, both were quite positive and quite positive for our markets, which is why we saw the kind of rally that we did over this month. For the year so far, we are coming to the end of the year. We still Nifty has gone up by around 18-19% for the year. Don't hold me to the exact decimal, but essentially we are still one of the better performing markets in the region and globally. If you look at the region, Asia Pacific per se, apart from China, most of the markets have kind of eked out positive performance for the year so far. And this is our third year of outperformance to China, starting 2021. If my memory serves me right, if you start looking at our markets starting 2021, we've outperformed MSCI China by almost 70% in US dollar terms. The good part is a lot of the performance is because of structural reasons in our market, structural improvements in our economy. But at the same time, our valuations have gotten a bit expensive. They are a bit more. We are at the costlier end of the spectrum, especially when compared to our Asia Pacific peers. So we may see time correction in our markets, but essentially our fundamentals are quite strong. So one should not see a substantial market correction, but more of a time correction is what I expect to see in the markets. So that's markets at my end. Happy to delve into the details subsequently in the Q&A. What I'll do is let me share the PPT on arbitrage, and then we can start the fund. Tanvi, let me know when you're able to see the screen, please.
Karthik, I'm able to. You can go ahead.
Okay. 1 second, let me mute. Okay. So first, let's start with what is arbitrage. Arbitrage is nothing but when you have the same product selling at two different price points in different markets. And if you're able to kind of buy it in the cheaper market and sell it in the costlier market, then you're locking in that price differential. And if you're able to do that, that's arbitrage, because when you are about to buy that commodity or buy that object in the market, you know what you can sell it for with 100% assurance, right? So think about it like petrol, right? We cannot obviously buy and sell petrol as individuals, but we all know the petrol prices kind of vary from state to state because of state taxes. Right, in Gujarat it's cheaper. It's Maharashtra, it's costlier by 10 rupees. So if you could, in an ideal world, essentially buy it in Gujarat and sell it in Maharashtra, you know the price differential is 10 rupees. That's arbitrage for you, right? So that is what arbitrage is at the root of it, where you know what are the entry and exit points, and you are not taking any risk, but essentially you are kind of market making in between, right? That is what arbitrage is. Now, if we come to arbitrage from a financial perspective and from a financial product perspective, then what you're looking at is the stocks, futures, and options. So there are three different instruments in here, but we will restrict this conversation to just stocks and futures. Now, as all of us know, there is a stock market and there is a futures market, and they should typically, and you have all these stocks, majority of the top 200 stocks also have futures that are traded simultaneously along with the cash market. Now, typically, one would expect that the prices on the futures market should mimic the prices on the spot market. But in reality, while that is true from a trend perspective, in reality, there is always a slight difference between the futures market and the spot market for various reasons, for various technical reasons, but essentially there is always a differential. When that differential becomes meaningful, then from a fund standpoint, it becomes quite lucrative to kind of trade the spread. What I mean by that is, let's say the stock is trading at a discount to the futures price, in which case we would go long the stock and short the futures at the same time. So you lock in your price in the cash market and you lock in the price in the futures market. So to give you an example, to give you an idea, let's say there is a stock that trades at 100 rupees in the cash market, and the futures on the same stocks trades at 101 rupees on the futures market. Then there's a differential of 1 rupee or 1%, right? And and we all know the futures in our markets expire at the end of the month. So you can earn that 1% just in that period of the month. So what we typically do is in an arbitrage fund, what we do is we go and buy the stock at 100 rupees and we sell the futures at 101 rupees. Now, by doing that, we are locking in that 1 rupee, and subsequently, whatever happens to that stock or the futures, it doesn't affect our profit on that particular trade. So let's take an example. Let's assume the stock price moves up to 105, in which case the profit that we've made on our cash position is 5 rupees, 105 minus 100. But at the same time, we've also lost money on the futures because we are short futures. And now the futures are trading at 105. So you lost 4 rupees on your futures position. So again, if you deduct that 5 minus 4, essentially you get to that 1 rupee profit that you locked in at the beginning of the trade. And the same thing, even when the stock price falls, if the stock price were to fall to 100, then the cash position, the gain that you have is essentially zero. While on the futures position, the future has fallen from 101 to 100. So you're again you still continue to maintain your gain of 1 rupee. And the extreme, if it falls to 95, then the loss on the cash position is 95 minus 100, which is 5 rupees. And you've gained on the futures because you're short futures. You've gained 6 rupees on the futures. So net, your gain is still 1 rupee. So as you can see in all the three scenarios, whether the stock price is rising, for remaining the same, or it is falling, in all cases your profit is just 1 rupee. So you've locked in. So you then are completely agnostic to what the market is doing there, and essentially there is no risk in that position once you've taken it, and that spread of 1 rupee will be harvested or will be realized at the end of the month, or even before, depending on how the market moves, because at the end of the because the futures have to expire at the end of the month, and at the time of expiry the prices of the futures have to match that of the stock prices, or else one can take physical delivery or one can give physical delivery depending on whether you are long the futures or short the futures. So that is how we structure arbitrage trades, where we go long on the stock price on the cash market and we short the futures. Now, typically, this is what constitutes bulk of the arbitrage book. So typically, it constitutes anywhere between 65 to 75% of the book is predominantly in these arbitrage trades. So what we do with the other 25 to 35%, depending on market conditions, is that we invest in debt securities. Now, the exposure to debt can be through our own debt mutual funds, or they can be through government securities, or in some cases it could be through CDs and CPs and so on and so forth. So the rest of the 25 to 35% or 20 to 35% is essentially in debt securities. So as a product itself, this product is kind of, once you've taken the positions, it is kind of immune to the volatility in the market on a daily basis, because you are not taking naked exposure to the market. By that I mean you don't have unhedged positions. So you know what is the gain, or what is the gain on each of your individual positions. The other big advantage that arbitrage funds have is essentially the tax advantage. Now, arbitrage funds are treated as equity funds for taxation reasons, in which case, what happens is, if you've held it for a short period of time, which is a holding period of less than 12 months, your taxation is 15%. And if you've held it for more than 12 months, then long-term capital gains tax are applicable, which is close to 10%. Unlike in case of debt funds, where if the holding period is for a shorter term, and in case of debt funds, shorter term period is defined as less than 36 months or 3 years. So again, there's a difference in tenure. With equity schemes, the short term capital gains is applicable for holding periods less than 12 months, whereas in case of debt, it is less than 36 months. So you need to hold above 36 months or more than 3 years to get benefit of long-term taxation, long-term capital gains rates. So when you hold it for 36 months or lower, then you are taxed at marginal income tax rates, which can be much higher than the 15% rate that you get taxed on for an equity fund. And if you hold it for 3 years, if you hold it for more than 3 years, then you're applicable for long-term capital gains tax rate, which is again 20%, whereas with long-term capital gains tax on equity funds, it is around 10%. It is 10%. So there is a distinct tax advantage to having to investing in this product. And so the after-tax returns of this product compared to its competitors, or not competitors, meaning compared to its alternate opportunity, or the opportunity set, the after-tax return on an arbitrage product is much more attractive. The other thing that is arbitrage fund going for it is a good way to kind of park your money for a short period of time. So if you want to park your money for 3 to 6 months in a very tax efficient platform, then arbitrage funds are a great way to park money. Now, so I've told you all the good things about arbitrage funds. So what are the things that you need to watch out for with this category? Now, as I said, what we do here is we go long stocks and we short futures for the most part. And obviously, there is a lot more details to it than just that. But principally, that's what we do. Now, when we do that, we are trying to capture the spread. The spread is not set in stone. The spreads changes from month to month, and it even changes intra-month, giving us opportunities to opportunistically take positions or churn our positions. So what I mean by that is, let's say over the last 4 to 5 months, essentially the spread on an average has been at around 65 to 70 bips, or rather 0.65 to 0.7% on a monthly basis. But that is just the average spread. So the spread end of last month was 60 bips or 0.6%. The spread 2 months back was 0.75%. So as you can see, there is a variation to the spread, and the spread is not set in stone. The spreads typically compress when the markets have a sharp correction. The reason is because we are short futures in this strategy, and if the market participants don't want to go long futures, who are the other side of the trade, then the spreads typically contract during times of strong market corrections. But barring that, the spreads are roughly sideways to they move kind of sideways to improve depending on what the market scenario is. So the spreads themselves are not set in stone. They have their own variability to it, which is why I emphasize that if you're looking to park your money for 3 to 6 months, or even 3 to 9 months, or to 1 year would be even better. If you're looking for to park your money for that period of time, then arbitrage is a great strategy to park it in, given the tax advantages that you get with it. And also, you also get liquidity here. You're not locking up your capital here, right? So again, just to emphasize, if you look at the strategy end of last month, the hedged equity, or what I call as arbitrage trades, constituted almost 70% of the book, whereas investment in debt mutual funds and investments in other debt securities constituted the other 29.8% of the fund. And again, this goes to our, on this slide number 10, if you look at the graph on the right-hand side, what you notice is that the market-wide futures open interest, which is the way of saying how much how much active participation are you seeing by market participants in the futures market. This shows you the degree of interest in participation in the FNO segment, and that kind of changes through time. And along with those changes, the spreads also change. So as the slides here tell you, at the end of November, the average spreads for an arbitrage position was 62 bips, but previously they've been much higher, going up as much as 75 bips. Now that spread has actually opened up post the state elections, when market participants have gotten bullish on the markets. The spreads have got opened up and they look much more attractive than they looked at the end of the month. So which is where the variability comes in, and which is where I request that investors come in for a reasonable period of time, right? So again, here we emphasize here the investment horizon being between 3 to 6 months. That will be ideal from a product perspective. And that's essentially it from my side in terms of just defining what an arbitrage fund is and how we manage it. Happy to answer any questions on the strategy, markets, or anything else that is of interest on me.
Yeah. Thanks, Karthik. That was actually quite informative. So, one of the questions which usually get asked when investors are investing in arbitrage funds is that, which funds would you compare it from the entire mutual fund basket? Which funds would be comparable to an arbitrage fund? Because as a bucketing, it falls under equity. But actually, the duration which you suggested right now was, say, 3 to 6 months. So, which would be the comparable asset class for an arbitrage fund?
So, the products that one would look at from an opportunity point of view is essentially money markets funds, ultra short funds, or liquid funds. These are typically areas where, or even your FDs, where people would park their money in, depending on the tenure that you're looking at. And you can look at arbitrage fund as one of the options. Whenever you're looking to invest in those strategies, please do consider arbitrage funds as one of the options in those category of products that you're looking at. As I said, the benefit that you get out of this strategy, and I can't emphasize it enough, is the fact that the tax treatment is very beneficial for the investor, which means that the after-tax returns, just don't look at the gross returns, look at the after-tax returns. The after-tax returns for an investor in arbitrage fund can be quite rewarding compared to some of the other products, depending on the time horizon and the period, of course, but largely that would be applicable.
Okay. Another question was that there are a couple of arbitrage funds in the market. So how does an investor choose which is the best one, or what would be the Axis Arbitrage Fund's advantage over other funds in the industry? Or how do we identify as a better fund?
At the end of the day, arbitrage funds are very operational products where you have to do a lot of the small nitty-gritty things correctly. It is not about looking for the next best idea, but it is making sure that you have systems in place to capture these spreads in the market, and you have a established setup to kind of monitor that and tweak the knobs wherever it is necessary, and take advantages of the small benefits that you get in the market from an ARB perspective, and keep going at it consistently with the same level of efficiency. Now, that is where an established setup kind of helps, where we've been running ARB strategies for quite some time. We have a long history of having done it. we do it in a very conscious way, where we make sure that we are not taking any unhedged bets, where we make sure that the systems that we have is able to capture the opportunities out there, and the product is run the way it should. And that purely comes from the fact that we we run it given quality, our emphasis on quality, whether be it at a stock selection level or be it in the way we run our processes, that has a bearing on how we run those funds. So it is just our history of having run that mandate for quite some time that gives us insight into how we should be managing this strategy.
Okay, great. Now, one of the questions which is usually people would want to know is, of course, that past performance doesn't really count, but what is the average returns that an investor can expect from these kind of funds?
So, as you rightly pointed out, it is kind of it is kind of difficult to put a number out there, but I'd say it should give you the same level of returns as what an ultra short or a liquid fund would give you at a gross level, and post taxes it should be better than that. Right?
Karthik,
and to give you an idea of it, as I said, the spreads over this year have been kind of the average spread on an arbitrage trade has been close to 70 bips on a monthly basis, and that constitutes around 70% of our fund. So that should also give you an idea of how the returns should trend there.
Okay, so that's exactly what I was coming to, is when you speak about the spreads which are there in the market, what is the kind of spreads which an investor should be okay that this is, say 60 to 70, somewhere between 60 to 70 bips is a comfortable time to invest into? Of course, higher the better, but then what is the average?
See, at the end of the day, it is also influenced by what is the interest rate regime and so on and so forth.
Yeah.
So what you should look out for is, what are your options? What are your alternate options? And how much arbitrage gives you over and above that on a tax adjusted basis at any given point of time? So if the entire space compresses because the interest rates interest rates start coming down and the entire space shrinks, then obviously the spreads even on arbitrage fund could kind of go lower. But at the end of the day, it could still deliver better returns compared to the other products available out there. Right. In terms of opportunity. So the point to look at is, obviously you should look at the spreads on an absolute basis, but also the other thing is to look at is what are your options in other product categories, how much are they giving you, and what is the differential that on an after tax basis that arbitrage fund can bring to the table.
Right. So as you just pointed out, that we should also see what are the other options. And currently the interest rates are at an all-time high, but saying so, in the last couple of RBI policies, we have seen a pause on the rates. And there is probably a possibility that maybe next year the interest rates could be going down. At the same time, we are seeing that equity markets are at an all-time high. So would you say that this is like a great time or a perfect time to come into arbitrage funds, where you would probably see that going forward interest rates on the debt market would go down, whereas equity markets are on a bull run?
See, when equity markets do well, the spreads kind of stay constant or the spreads improve. What we don't want from this product perspective is sharp corrections in our market when the spreads kind of compress. Otherwise, I'm kind of, or the strategy is kind of agnostic to whether the market's up or flat on a daily basis or a monthly basis, because you don't take any market risk. Once in this product, once you've locked in your positions, there is no market risk, right? The only thing that matters is that your investment horizon has to be reasonable, because you don't want that spread to hover you don't want to come in for a month trying to time these spreads. You want to come in for a reasonable period, which I call at least 3 to 6 months. And that is the most critical thing. Obviously, as if interest rates come down, then you may see the spreads compress. But then again, the question to ask, at the risk of repeating myself, is what is the opportunity set aside from arbitrage funds? But otherwise, as long as the markets are not correcting sharply, from a product perspective, it doesn't really matter. Uh, uh, Even if there's a bull run, it doesn't really matter because the spreads don't change radically in that case. If we see levels like what we are seeing today, that is good enough from my perspective.
Karthik, if you could highlight that in your experience of managing the fund, how exactly, how much does it affect the performance during an extremely volatile market?
Okay.
Say, even if the person has a reasonable horizon.
Okay. So even if during, let's say, you go back to Feb of 2020, which was the month where we had COVID, and March of 2020, those periods when the markets were extremely volatile, both under downside and upside. The spreads had compressed significantly, but still the returns were positive for that month. But the returns were, let's say, lower than what a typical cycle would have to offer, and that could have been compensated by better returns a few months previously or a few months after. But essentially, which is why I say don't try and time it for any particular month. But when I talk about correction, I talk about steep corrections like what you saw in Feb of 2020. I'm not talking about a minor correction like 2 to 3%. I'm talking about steep corrections is what we need to be concerned about.
Okay. So when we say that we are completely hedged, Karthik, does that mean that arbitrage funds will never give a negative return? One of the questions which is asked by the viewers.
So never is quite an extreme statement because technically the strategy can give you negative returns because let's say you invested in obviously the arbitrage position will never give you negative returns because you locked in those gains because you're long the equity or short the futures. So that arbitrage position will never give you negative returns because you go in knowing that your spread is positive, right? And once you've locked in that position itself would not give you negative returns. That will always be positive, and you know what that number is when you take a position. You know what the number is. But technically, you could get let's say you have something on the debt side that kind of doesn't go to plan. Then you could potentially have a negative month in that strategy. But the way we manage the strategy is that we know why an investor comes into the fund. What is the aim of the investor that is trying to park money into this fund, and what time horizon he or she is looking at? So the kind of exposures that we take on the debt side are quite conservative, and so that should make it a very unlikely possibility. But if you ask me, will it be never? That never word itself is quite extreme, so I would leave it out. But we take quite a conservative view with regards to our debt allocations.
Okay, great. One of the questions has also been, are there any challenges faced by arbitrage funds managers in India in case of operationally or otherwise?
There are no special challenges. It is just going. It's getting your infrastructure and making sure you have the right set of infrastructure and right set of policies to trade in. So I can't think of anything particular that we as a country face or this product as a product group faces in our country. I can't think of anything particular.
Another question is, Karthik, that how much allocation of the entire portfolio should an investor think of investing in arbitrage funds?
As I said, it is a way to park your money. It is a way to get good after-tax returns, along with access to liquidity. So you can use it in several different ways that you want to. Let's say you're trying to. You can use it to park your money here in arbitrage funds and then kind of move your allocation slowly to equities or some other product category that you want to invest in. So wherever you so whenever you think about investing in, let's say, keeping it in FDs or keeping it in liquid funds or money market or ultra short, then that should be your alternative. There is no fixed percentage as a fixed share as a percentage of your total portfolio. I'd say when you need capital, when you need liquid, where you don't know how long you want to keep it for. You need at least 3 months, but 3 to 6 months, but you don't know how long you will need it for. Then this strategy is great because it offers you liquidity, it offers you better tax adjusted returns.
Great, Karthik. That's about it, the number of questions which we've had. Thank you so much, everybody, for attending this session, and hopefully we'll have something soon coming up.
Thanks, Tanvi, for
Thanks a
that.
lot. Thank you.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.